Hello everyone, welcome to Advanced Accounting. This is our first lesson following our first exam. Speaking of the first exam, I was overall pleased with the exam scores. I feel that everyone did fairly well on it. And as I said before in the email when I gave everyone's scores, if you're interested in reviewing that exam or have any questions about it, please come see me in my office during my office hours or just shoot me an email. Um, Moving forward, we are now finished with dealing with consolidations. So we'll be moving on to some new material. Today we're going to be starting the international accounting environment. So you can see here on our Moodle page, we've got the PowerPoints up, and then we have actually two different sections we're going to go over tonight. We're going to go over Chapter 9 and the derivatives module. And you can see here we already have the homework that is available for Chapter 9 homework. We're going to complete exercises 2 and 4. And for the derivatives module, we're going to complete exercise 3 and 4 and also understanding the issues number 4. And in regards to the homework due date, I've actually moved it up to being due Monday, but it is still going to be due at 11:55 p.m. on Mondays instead of before. I know I said I was going to make it due on Tuesdays or Wednesdays. I just don't see the need to drag it out farther because by that point we will have already moved on to newer content. So I want you to be focusing your efforts on that instead. So for now on moving forward, homework will be due the following Monday at 11:55 p.m. That way it'll still give you the chance to go over what the answers are as we review them in class before you submit your work so that you get full credit for the assignment. But as I mentioned before, please try to attempt the homework prior to me going over it in class. That's the whole point of doing the homework, is so that you can actually see the stuff and struggle with it, and then it'll make sense when we go over it. Content here, we'll start with Chapter 9, the international environment. So let's look at our learning objectives here. Now, trade between different nations certainly is not new. It's existed before biblical times and has provided the means by which certain nations have evolved into the world powers that they have become today. Now, since World War II, international trade has increased significantly, and many more goods and services are becoming part of a global economy. Now, the growth of the European Union has been responsible for reducing the economic barriers between nations by forming a single market with its own common currency, known as the euro. Now, the comprehensive free trade agreements, such as the North American Free Trade Agreement, also known as NAFTA, and the American Free Trade Agreement, known as AFTA, as well as the World Trade Organization, the WTO, are all committed to reducing the trade barriers through multilateral agreements. So now not only are goods and services traded in international markets, but the stocks of these companies are also traded internationally. Now, international securities trading is going to also offer investors the opportunity to diversify their portfolios against the loss from currency fluctuations, political instabilities, and even economic downturns. So now, foreign currency transactions. Today, there are almost 200 countries in the world and almost as many different currencies that are being used throughout the world. Now, business transactions that are settled in a currency other than that of the domestic currency are going to be referred to as foreign currency transactions. One of the transacting parties will settle the transaction in its own domestic currency and also measure the transaction in its domestic currency. For example, let's assume a German company may sell inventory to a U.S. company and require the payment to be in euros. The currency used to settle the transaction is going to be referred to as the denominated currency, and in this case would be the euro. The other transacting party will settle the transaction in a foreign currency, but will need to measure the transaction in its domestic currency. So let's assume a U.S. company that purchases inventory from a German company must settle the resulting accounts payable in euros and yet must measure the purchase of inventory and the accounts payable in terms of the U.S. dollars. The currency used to measure or record the transaction is going to be referred to as the measurement currency, and in this case would be the U.S. dollar. Now, whenever a transaction is denominated in a currency different from the measurement currency, exchange rates risk exists, and exchange rates must be used for the measurement purposes. The process of expressing a transaction in the measurement currency when it is denominated in a different currency is referred to as a foreign currency translation. All right, now an example involving a purchase of inventory from a German company. Now let's assume the inventory was purchased for 13,200 euros when the dollar was equal to 1.2 euros. Now at the time of the purchase, the respective parties would recognize the German company is going to recognize sales revenue of 13,200 euros and accounts receivable of 13,200 euros, and the U.S. company is going to recognize inventory of 11,000 and accounts payable of 11,000. Now let's assume that the dollar was equal to 1.10 euros at the time of the settlement of the transaction. Now at that time, the German company would still receive the 13,200 euros in settlement of its receivable. However, the U.S. company would have to spend 12,000 in order to settle the accounts payable rather than the 11,000. Now, in this case, the U.S. company has experienced an economic loss due to the changes in the exchange rates over time. Whenever a transaction is denominated in a currency different than the measurement currency, one of the parties to the transaction is going to be exposed to either an economic gain or a loss if the exchange rates change between the date of the transaction and the date of the settlement. Now, foreign currency translation. The magnitude of U.S. investment abroad has increased significantly in response to a more global economy. Now, a reduction in trade barriers and the growth of international capital markets. Similarly, these same factors have encouraged an increase in foreign investment in the United States. So foreign currency translation is ultimately the process of expressing amounts denominated or measured in foreign currencies into amounts measured in the reporting currency of the domestic entity is referred to as foreign currency translation. Now, in order for the domestic company to prepare a consolidated financial statement that reflects its 100% interest in the foreign subsidiary, the domestic company must translate the financial statements amounts from the euro into the US dollar using rates of exchange between the two respective currencies. Now, several issues come to mind concerning this translation process. First, what impact will changes in the exchange rates between the currencies have on the parent company's cash flows? And secondly, what rates of exchange should be used to properly capture the impact of exchange rate changes? Now, in addition to these issues, what about the possibility that the accounting principles used by the foreign entity are not the same as those of the domestic entity? Harmonization of accounting standards. Harmonization of accounting standards has as its goal the development of consistent accounting standards that will improve comparability of financial information. Now, multinational companies must have comparable accounting standards with which to measure the effectiveness and efficiency of their various international subsidiaries, branches, or other equity investments. Also, in order to efficiently allocate and regulate the exchange of capital, international capital markets need to evaluate the adequacy of financial statements and disclosures made by those companies seeking to raise capital. And also, other users, such as suppliers and customers, who are exposed to opportunities on an international scale, need comparable financial information upon which to base their decisions. So, therefore, the development of international accounting standards must be based on an understanding of international business and markets that the factors that affect the accounting in various countries. So, factors influencing the development of accounting. So, accounting is not defined by nature, but rather is made by humans. It evolves from the environment in which humans exist and defines itself in a way which serves the needs of that environment. Now, the development of accounting principles and standards is an extremely complex process involving a social and cultural environment, various special interest groups, and varying degrees of due processes. It is the factors influencing the process that vary from nation to nation. Now, a number of environmental factors may explain these differences to varying degrees. Some of these environmental factors include social and cultural values, political and legal systems, business activities and economic conditions, standard setting processes, forms of ownership and capital markets, and cooperative efforts between nations. Now, although a number of environmental factors have influenced the development of accounting standards throughout the world, there's a growing momentum toward the movement of a single set of international accounting standards. So now let's just think for a second here. How could some of these factors influence the development of accounting? So what about political and legal systems? Think about different politics that get in, different agendas that they have. Or what about tax laws? So tax laws could ultimately affect, the accounting system as far as what we can expense or what we can capitalize, or what's included is an income tax liability and just stuff of that sort. So economic conditions can also influence it in regards to whether the inflation is a hyperinflation economy or if it is just a stable economy. So just different factors definitely influence the development of accounting standards. Now, the International Accounting Standards Board. So standard setting on a worldwide scale represents a monumental task, and the leaders of this movement must be sensitive to the variety of cultural, ethical, and economic differences that exist among different countries. Now, this approach to the harmonization of accounting standards is the dominant approach and major forces behind the efforts that have been the International Accounting Standards Board and also the International Federation of Accountants, known as the IFAC. Now, the International Accounting Standard Board is going to be concerned with the promulgation and harmonization of international accounting standards. Now, the International Federation of Accountants is going to be concerned with a variety of issues affecting the professional practice of accounting, not only on a single basis but on a worldwide basis, including quality control standards and international auditing standards. Now, the IASB was going to be created in 2001, or was created in 2001, as a result of restructuring of its predecessor, the International Accounting Standards Committee. The IASC was formed in 1973 and had two primary objectives: formulate and publish standards on financial accounting and reporting and promote their worldwide acceptance. 2, work for the harmonization of accounting standards and procedures that are relating to the presentation of financial statements. Now, rather than each nation establishing its own accounting standards, the IASC recognized the importance of taking a global approach toward standard setting in order to best serve the global economy. Now, the International Accounting Standards Committee Foundation It was formed in 2001 as a parent entity of the IASB, and it's based in London. Now, the structure of the foundation consists of the trustees, the board, the Standing Interpretations Committee, and the Standards Advisory Council. Now, the trustees of the IASC Foundation are the ultimate governing body and appoint the members of the IASB, the Standard Interpretations Committee, and the Standards Advisory Council. The 22 trustees come from a variety of countries and have diverse professional backgrounds. Now, the makeup of these 22 trustees come from, it says they come from different countries. Of those countries are 6 from North America, 6 from Europe, 6 from Asia and the Oceania region, and 4 from any area being sensitive to geographical balance. Continuing on with the International Accounting Standards Boards. These are going to be appointed by the trustees of the IASC Foundation, and the board is going to consist of 16 members. Each board member has 1 vote and may serve a term of up to 5 years, renewable once for a 3-year term, which is subject to certain exceptions for the chair and the vice chairs. Now, the board has responsibility for establishing a single set of international accounting standards that are now designated as International Financial Reporting Standards. The International Accounting Standards issued by the IASC have been adopted by the IASB and continue to be referred to as IAS. The IASB has followed a conceptual accounting framework. The framework is known as the Framework for the Preparation and Presentation of Financial Statements. And this was approved in 1989 by the IASC and later adopted by the IASB in 2001. Now, this framework sets forth the concepts that underlie the preparation and presentation of financial statements for external users, and also serves as a platform against which future standards are developed and existing standards are reviewed. The board follows a rigorous due process leading to the issuance of IFRS. This process includes open meetings, webcasts, the possible use of an advisory committee, and the publication of discussion documents and exposure drafts for public comment. So the International Financial Reporting Standards Interpretations Committee. So the trustees also appoint the 14 individuals to the Interpretations Committee. The committee is responsible for reviewing accounting issues that arise in the context of IFRS and to provide authoritative guidance in the form of interpretations that are known as IFRIC. Now, convergence to international accounting standards. The factors that have influenced the development of accounting standards within nations continue to exist, and there is a recognized need to move toward a single set of international accounting standards. Now, a significant number of national accountancy organizations also recognize the importance of harmonization, and nearly 120 countries have either adopted IFRS, allowed the optional use of IFRS, or substantially converged with IFRS. The United States continues to use national accounting standards subject to the areas in which the standards have converged with IFRS. So some of the initiatives of the Financial Accounting Standards Boards, also known as FASB. So the FASB believes in the ultimate goal of a single set of international accounting standards that would be used worldwide for domestic and international financial reporting. Now, in keeping with this commitment, the FASB and the IASB in 2002 signed a Memorandum of Understanding, also known as the Norwalk Agreement, formalizing their commitment to the convergence of U.S. GAAP and international accounting standards. Convergence means that the FASB and the IASB will work together to develop standards rather than the FASB merely agreeing to adopt IFRS. So this will be a collaborative effort whereby IFRS may converge with US GAAP may converge with IFRS, or an entirely new standard may be generated. Now in 2006, the FASB and the IASB published a memorandum of understanding that reaffirmed their mutual commitment. And it set forth a roadmap identifying convergence topics and encouraged the Securities and Exchange Commission, also known as the SEC, to allow public foreign companies to file statements according to IFRS without reconciliation to US GAAP. So now what's so huge about that is just because it's such a burdensome process to do so. So therefore, by allowing these foreign companies to register their securities, and these companies register with the SEC and IFRS without having to actually reconcile it to US GAAP, is going to enable a lot more of these foreign companies to get on the exchange, which in turn just means more money to be invested in and more growth to those capital markets. So it's really a big steps in the SEC allowing these foreign companies to file their statements according to IFRS instead of reconciling with US GAAP. Now in 2010, both parties reaffirmed their earlier commitment to the 2006 Memorandum of Understanding and also expanded their efforts to create new accounting standards where existing standards were deemed to be in need of significant improvement. Now US GAAP has historically been more rules-based than IFRS, which is more principles-based. This will certainly introduce much more subjectivity into financial reporting. There may also be certain areas where convergence might not be achieved. For example, the LIFO inventory method is a common and popular method within the United States. However, IFRS does not allow LIFO. Now, the FASB and the IASB have pledged to make their accounting standards fully compatible and maintain such compatibility over time. So some of the convergence initiatives of the Securities and Exchange Commission. Now in 2010, the SEC adopted a timeline that anticipated 2015 as the earliest date the SEC would require U.S. companies to use IFRS in filings with the SEC. Now since that time, the SEC's position regarding the adoption of IFRS has become less clear. Now, in spite of this uncertainty, it is interesting to note that the SEC has agreed to accept financial statements from foreign registrants to be prepared in accordance with IFRS without reconciliation to US GAAP, as we know because we just discussed that on the previous slide. So that is the end of chapter 9 for the international accounting environment. You have the homework assignment for chapter 9 here. This is a fairly short chapter, pretty self-explanatory. I mean, it's just getting into the foreign aspects of financial reporting with the IASB and some of the differences. So just please read chapter 9 in your book. It'll help clear these slides up and review over these slides. So with that, we will end chapter 9 and move on to the derivatives module. So derivatives and related accounting issues. So the use of derivative instruments has increased significantly among both financial and non-financial corporations. Now these instruments derive their value from changes in the price or rate of a related asset or liability. For example, the option or right to buy a share of a stock at a fixed price derives its value from the price of the related stock. Derivative instruments may be held as investments or part of a strategy to reduce or hedge against exposure to risks associated with some other transaction. Now, the Financial Accounting Standards Board, FASB, has issued multiple standards for derivatives that require them to be recorded as assets or liabilities at fair value. Now, these standards are pretty complex, and they are going to be they're actually in the FASB's accounting standard codification, in particular ASC topic 815, derivatives and hedging. And these standards are developed from two critical underpinnings. The first one being that derivatives represent an asset or a liability, and derivatives are to be measured at fair value. So let's get in here and look at some of our learning objectives. We're going to state the general characteristics of a derivative instrument and define underlying and notional amounts. Explain the basic features of common derivative instruments, including forward contracts, futures contracts, options, and interest rate swaps. Determine and account for the change in value over time of forward and future contracts. Determine and account for the intrinsic and time value components of an option. And appreciate the basic objectives of an interest rate swap. Explain how a derivative instrument may be used to reduce or avoid the exposure to risk associated with other transactions. Demonstrate how a fair value hedge is used and account for such hedges. Demonstrate how a cash flow hedge is used and account for such hedges. Identify the various types of information that should be included in disclosures regarding derivative instruments and hedging activities. So, derivatives. Financial instruments that derive their value from changes in the value of a related asset or a liability. As we said before, it may be held as an investment or as part of a strategy to manage certain transaction risks. Now, U.S. GAAP reflects two critical underpinnings, as we just said. Derivatives represent assets or liabilities, and derivatives are to be measured at fair value. So what are some characteristics of derivatives? A critical characteristic of a derivative, and the basis for its name, is that the instrument derives its value from changes in the value of a related asset or liability. The rates or prices that relate to the asset or liability underlying the derivative are referred to as underlyings. The underlying may take a variety of forms, including a commodity price, stock price, foreign currency exchange rate, or interest rate. Now, it's very important to note that the underlying is not the asset or liability itself, but rather its price or rate. So remember, the underlying is not the asset or liability itself, but rather its price or rate. Now, in order to fully value a derivative, one must know the number of units or quantity that is specified in the derivative instrument. Now, this is called the notional amount, and it determines the total dollar value of a derivative, traceable to movement or changes in the underlying. The notional amount of a derivative might refer to so many bushels of a commodity, number of shares, foreign currency units, or principal amount of debt. Now, both the underlying price or rate of the notional amount are necessary in order to determine the total value of a derivative at any point in time. Now, typically, a derivative is going to require little or no initial investment because it's an investment in a change in a value traceable to an underlying, rather than an actual investment in the actual asset or liability to which the underlying relates. So we're not actually buying the asset or the liability. We're just actually investing in the change in that asset and liability over time. So that's the main difference here. Not actually buying the asset or liability. We're just buying the actual change in that asset or liability. So many derivatives do not require the parties to the contract, the counterparties, to actually deliver an asset that is associated with the underlying in order to realize the value of a derivative. So the ability to settle the contract in exchange for cash without actually buying or selling the related asset or liability is going to be referred to as a net settlement. So we can get the actual net realized value or the net effect of this transaction without actually buying the asset, by just actually buying into what the changes in these assets are, the changes in the value of these assets are. Now, a derivative may be a separate, distinct financial instrument, or it may be embedded in another financial instrument. An embedded derivative has economic characteristics and risks that are not clearly and closely related to those of the host instrument. For example, a convertible bond is a host contract that also contains an embedded derivative. That derivative represents the option to convert the bond into common stock. Its underlying is the price of the respective stock. So just as a note here, we're not getting into it because it really is beyond the scope of this text, but if the embedded derivative meets certain criteria, it could be separated or bifurcated from the host contract and be accounted for as a separate instrument. But as I said before, we're not going to get into the subject of bifurcation. So what are some common types of derivatives? So most derivatives are variations of four basic types, which include forwards, futures, options, and swaps. Now, derivatives are often part of a trading portfolio and are held primarily for sale in the short term. Now, as with other trading investments, derivatives are marked to market, and the resulting gain or loss is going to be recognized currently in earnings. A specific discussion of each type of derivative follows. In this section, we cover derivatives as investments made for speculative purposes. So forward contracts. What is a forward contract? It's an executory contract to buy or sell a specified amount of an asset, such as a foreign currency, at a specified fixed price with delivery at a specified future point in time. The party that agrees to sell the asset is said to be in a short position, and the party that agrees to buy the asset is said to be in a long position. The specified fixed price in the contract is known as a forward price or a forward rate. The current price or rate for the asset is known as the spot rate. The specified future point is referred to as the forward date. Now, the difference between the spot rate and the forward rate at inception is referred to as the premium or discount and is going to represent the time value of the contract. Forward contracts are not formally regulated on an organized exchange, and the parties are going to be exposed to a risk that default of the contract could occur. Now, the value of a forward contract is zero at inception and typically does not require an initial cash outlay. Now, however, over time, the movement in the price or rate of the underlying results in a change in the value of the forward contract. So the total change in the value of a forward contract is going to be measured as the difference between the forward rate at inception of the contract and the spot rate at the forward date. So once again, the total change in the value of a forward contract is measured as the difference between the forward rate at inception of the contract and the spot rate at the forward date. So let's look at an example of a forward contract. So let's assume that on April 1st, a party, which in this case called the writer, writes a contract in which he or she agrees to sell to another party who agrees to buy a million foreign currencies. In this example, euros, at a specific price of 16 cents per foreign currency, with delivery in 90 days, or on June 29th. So in this case, the person writing the contract is called the writer, and he agrees to sell, which is the short position, to another party. So the person holding who agrees to buy it is the holder. So let's look at the relationship between the parties. So we can see we have the writer of the contract on the left, and he is going to sell a million euros in 90 days to the holder of the contract. And in order for the holder of the contract to have this, he's going to pay 16 per euro in 90 days. Or 16 cents per euro in 90 days, I'm sorry, which will equal 160,000 in 90 days. Now, if the spot rate at the end of the forward period is going to be 18 cents, the total change in value is going to be determined as follows. So we see the euros at April 1 90-day forward rate is 160,000. So the way we get the way we derive 160,000 here is going to be the 0.16, the original, the 16 per euros in 90 days, times the million, and that'll give us $160,000. Now we get the $180,000 because we said let's assume that the spot rate or the forward period, the spot rate at the forward period is 18 cents. So obviously the same as we got the 160,000 by doing 16 cents times a million, we're just going to do 18 cents times a million, which will give us $180,000. So we're going to have a gain of $20,000 on the gain in the value of the forward contract of $20,000. Now this is a gain because on June 29th, the holder received something with a fair value greater than the fair value given up that day. So obviously this would be a loss to the writer, but it's a gain to the holder. So the holder of the forward contract could buy foreign currencies for $160,000 because remember, he's buying them right here. He's buying them for $160,000 in 90 days. So we're at that point right here on April 1, right? But on June 29th, we're still going to pay this amount right here of $160,000. But in all reality, it's really worth $180,000. So that's why we're getting the gain of $20,000 because the holder of the forward contract could buy foreign currencies for $160,000 on the forward date, compared to the spot value of $180,000 at the time, and experience an immediate $20,000 gain. So the value of the currency at the final spot rate could have been less than $160,000. So in that case, the holder would have experienced a loss and the writer a gain. Now, when the value of a derivative can change in both directions, a gain or loss, it is said to have a symmetric return profile. In the case of a forward contract, if the holder of the contract experiences a gain in value, then the writer of the contract simultaneously experiences a loss in the value. So the forward price or rate is a function of the number of variables, including the length of the forward period and the current spot rate. So measuring changes in the value of a forward contract over time, the cumulative change in the forward value of a contract is measured as the difference between the original forward value and the remaining forward value. The net present value of the change in forward value consists of two components: the change in the spot rates over time and the change in the time value of the contract, which is going to be the spot minus the forward differences. So more on measuring the changes in the value of a forward contract over time. So first thing, we want to see the cumulative change in the forward value. We can see here at the top of this little chart here of the 60 days remaining, 30 days remaining, the total life of the contract. So how do we get these values here? The change in the forward value is going to be the forward rate times the notional amount, and obviously the change and what that forward rate is from the difference in the remaining term of the contract. So that's how we're going to get it. So for example, in the beginning, it was $160,000 was the total forward value of the contract. So next, for the change in the forward value of $10,000, 0.17 times a million, this gives us $170,000, which is $10,000 more than the original 160. And then again at 30 days, it was 0.17 times a million, which is 170,000. That's still 10,000 more than the original 160. So let's look here. So look at the present value of cumulative change. We can see 60 days at 6%. So down here, the present value calculations based on a 6% is going to be 0.5% per month, because obviously 6% divided by 12, because there's 12 months per year, is going to be 0.5% per month. So 60 days out, we have the $10,000, which is the cumulative change, divided by 1.005 to the second. Okay, because we still have the other remaining periods left, if you recall. This is based on the remaining time, remaining forward contract over time. So that's going to leave us with the present value of the cumulative change right here is that 10,000 is actually 9,901 when applying this formula right here. So what about when we're 30 days at 6%? So 30 days, we're still at the cumulative change of $10,000 here. 10,000 divided by 1.005 is going to give us 9,950. So that is what the present value of the cumulative change at 30 days at 6% is right here. 0 days, $20,000. Previously recognized gain or loss. So right here we can see the $10,000, 9,901. Previously recognized gain. We're not taking anything away from it because prior to it there was no gain. What about 30 days remaining? Previously recognized gain, 9,901. Here's the gain right here. Because remember the present value of the cumulative change, that was a gain. So we have to reduce that from the present value of the 30 days at 6%, which will give us $49. And this is the current period gain or loss. So in the first 60 days, or when we had 60 days remaining, we had a current period gain of $9,901 because of the present value of the cumulative change. So we have to factor in that we've already made this gain here. So the only change is now it's 9,950. So the difference is $49 between the two. So that's how we get the current period gain here. And obviously the difference between 20,000 and 9,950 is 10,050. The 9,950 is gotten from this right here because that's the previously recognized gain or loss, 9,950. So the total life of the contract, the current period gain is going to be 10,050. So note that the total change in the value of the forward contract is $20,000. Okay. So it's going to be the 9,901 plus the 49 plus the 10,050, which will give us $20,000. And that's the total life of the contract, so it matches here. So we can see here is the present value of these. At the end, it's going to equal the 20,000. Once again, that's the 9,901 plus the 49 plus the 10,050. Now this is going to be recognized over the term of the contract as a net present value of changes in the forward rate. So that's what we've seen here was a net present value of the changes in the forward rate. Even if the forward rates did not change between two valuation dates, in this case between the 60 days and the 30 days remaining, the value of the contract would change because the remaining term of the forward contract continues to decrease and the present value of the forward value increases. So we can see that right here in this example. So future contracts. A futures contract is exactly like a forward contract in that it too provides for the receipt or payment of a specified amount of an asset at a specified price with delivery at a specified future point in time. Now the futures contract has the following distinguishing characteristics. So unlike forward contracts, futures contracts are traded on organized exchanges. Now the exchanges help ensure that the trading partners honor their obligations. The exchange clearinghouse actually becomes an intermediary between the buyer and the seller of the contract. So in essence, the clearinghouse becomes the seller for each buyer and the buyer for each seller. The formal regulation of future contracts results in contracts that are standardized in nature versus customized. So for example, the exchange specifies the quantity and quality of commodities traded as well as the delivery place and date. A futures contract requires an initial deposit of funds with the transacting broker. This deposit is referred to as a margin account. It serves as collateral to help ensure that the parties to the contract are able to perform. So each day the contract is valued and marked to market. If the contract loses too much value, the holder will have to contribute additional cash to the margin account. If the margin account balance falls below a minimum balance, called the maintenance margin, the investor is required to replenish the account through which is called a margin call. Forward contracts represent cash amounts settled only at delivery and therefore represent future amounts that must be discounted to yield a current present value. However, future prices are marked to market each day. At the close of each trading day, a new futures price or settlement price is established. Therefore, the futures price represents a current versus future value and no discounting is necessary. This new future price is used to compute the gain or loss on the contract over time. Now, the party that has written a futures contract is said to be short, and the party that owns the contract is said to be long. So here's an example of a futures contract. Let's assume one buys 50 contracts on the Chicago Board of Trade to receive November delivery of corn to a certified warehouse. Now, each of these contracts is in units of 5,000 bushels at a futures price of $2.50 per bushel. Notice that the terms of the contract are standardized. Now, a second party must agree to sell corn at November futures price of $2.50, obviously. So, acting as an intermediary between the counterparties, the CBT, which is the Chicago Board of Trade, is going to write a contract to sell a corn future to pay the first party and buy a contract to purchase corn future from the second party. So let's look at the relationship between the parties. So we can see here, here's the clearinghouse, acts as the intermediary between the short and the long. So the short is going to sell the corn to the clearinghouse, whereas the long will buy the corn. The clearing also sells the corn to the long and buys corn from the short. So pretty much just however it is. For the short, it's going to sell the corn to the clearinghouse and it'll buy corn from the short. Same thing with the longs. The clearinghouse will sell corn to the long and buy corn from the long. So let's see here. So let's look at this little time graph here of the different days. Because remember, each day it's marked to market. So that's why we're looking at these little amounts on each day here. So day one, we know it was $2.50 per bushel, right? On day two, it's $2.51 a bushel. So we're actually going to have a gain on the contract here because it's went up 1 cent per bushel. So we have 50 contracts. Recall we have 50 contracts. Each had 5,000 bushels. So we're going to multiply that by the one penny, which is the spread between 251 versus 250. So 251 minus 250 times the 50,000 or the 5,000 bushels times the 50 contracts is going to give us the $2,500 gain. So let's look here. It's marked to market on day 3. So it went from on day 2 to $2.51 per bushel to $2.49 per bushel. So once again, this is showing we have a $5,000 loss on this day, and that's going to be we're going to get the $5,000 loss once again because we have 50 contracts multiplied by 5,000 bushels because each contract has 5,000 bushels, and once again the spread, the difference is 2 cents between 251 and 249. So that's how we get the $5,000. Same thing here from day 3 to day 4. We went from 249 to 247, so that's another $5,000 loss. Remember, we have 50 contracts. Each contract has 5,000 bushels, so 50 contracts times 5,000 times the spread, whatever the difference is between this right here, the variance. So pretty simple here. So it's marked to market each day. No need to discount the values. We have the intermediary here, the clearinghouse, because it's on an organized exchange to keep these parties from defaulting on their obligations of the contract or firm commitments. And like I said, from each day they're marked to market so we can see whatever the loss is based upon whatever the quantity of the contract is and the number of contracts. So the value of the futures contract is influenced by either positive or negative movements in the underlying price. Therefore, the risk associated with the contract is symmetrical. Unlike forward contracts, the value of futures contracts which typically change on a daily basis, can easily be monitored since contracts are traded on the open market. So that's how we are able to do this, because it's traded on the open market. Option contracts. An option represents a right rather than an obligation to either buy or sell some quantity of a particular underlying. Some common examples include options to buy or sell stocks, a stock index, an interest rate, foreign currency, oil, metals, and agricultural commodities. The option is valued for a specified period of time and calls for a specified buy or sell price. This is going to be referred to as the strike price or exercise price. Now, if an option allows the holder to buy an underlying, it is referred to as a call option. An option that allows the holder to sell an underlying is going to be referred to as a put options. Now, options are actively traded on organized exchanges or may be negotiated on a case-by-case basis between parties. So this is over-the-counter contracts if they're negotiated on a case-by-case basis. But ultimately, they are traded on an organized exchange. So option contracts require the holder to make an initial non-refundable cash outlay, which is known as the premium, which is represented by the option's current value. Now, the premium is paid in part because the writer of the option takes more risk than the holder of the option. The holder can allow the option to expire, while the writer must comply if the holder chooses to exercise it. So during the option period, the strike price of the option on the underlying is generally different from the current value of an underlying. So the following terms are used to describe the relationship between the strike price and the current price. So now, this right here, this little chart here is not including the premium, so it's not considered into these relationships. So the premium is not included here. And remember, the value of an option consists of the intrinsic value and the time value. So if you recall, we have two types of options. We have a call option and a put option. The call option gives us a right to buy. The put option gives us the right to sell. So let's see, what if the strike price is equal to the current price in regards to a call option? That means we're at the money. What if the strike price is greater than the current price? Then we're out of the money. The reason we're out of the money here, if the strike price is greater than the current price, because we have a right to buy a certain asset or a certain stock or whatever it is. So we have the option to buy it, right? So if we have the option to buy, if the strike price is greater than the current price, really we're out of the money, because it does us no good, because we'd be buying it at a higher price than what the current price is, so we're out of the money. But on the other hand, if the strike price is less than the current price, then we're in the money, because if we could buy whatever the stock is, if we could buy that stock at the strike price, which is less than the current price, then we could buy it for less than what it's actively trading, and we'd have an absolute gain or an instant gain per se, because we can buy it at a lower price than what it's actively trading. So we can buy it lower and sell it higher, and the difference there in the price would be our immediate gain. So on the other hand, let's look at the put option. So if the strike price is equal to the current price, once again we're at the money. So strike price equals current price at the money. Now what about if the strike price is greater than the current price? Then we're in the money. So why would we be in the money in this aspect if we're going to sell it? So think about it. If the strike price is greater than the current price, we're in the money, because we could actually sell it at that strike price, which is higher than what the current price is currently trading for. So therefore, whatever the difference is between the strike price and the current price, that's all our gain right there, if we have the right to sell it at that strike price when it's greater than the current price is what they're selling for. Now what about if the strike price is less than the current price? in that case, we're going to be out of the money because we ultimately do not want to sell it for less than what it's currently trading for. Now, as the table suggests, in the money is a favorable condition as compared to being out of the money, which is obviously an unfavorable condition. Now, the original premium is not considered when describing whether an option is or is not in the money. But it is important to note that the original premium is considered when determining whether an investment in an option has experienced an overall profit, which makes sense. Because obviously, if we have to pay for that premium, then we have to net that against whatever the actual in the money value is on the option. So the holder of an option has a right rather than an obligation and will not exercise the option unless it's in the money. So that's nice little feature about options. It's also good to know that. So let's look here. So let's say the holder of an option. So potential for the gain is unlimited for the holder of an option. And the potential for a loss for the holder of an option is limited to the amount of the premium. So think about it. So if we are the holder of an option, we paid a premium to have to be able to exercise a right either to buy or sell that option. If we're not in the money, then we're not going to exercise that option. We just let it expire, so we've lost whatever that premium cost us. So that's why the loss is limited to the amount of the premium. The holder of the option, the gain is unlimited because in all reality, the market can move up or down whatever it just indefinitely as much as it can. So really, whatever the strike price is, compared to whatever the market's moved, it's unlimited, however much it is. So what about the writer of an option? The potential for a gain is limited to the amount of the premium, obviously, because that's all the writer's receiving is the premium. Because if you recall, the writer has to perform if the holder exercises that right of that option. So therefore, the loss is unlimited. For the potential loss is unlimited for the writer of an option because, as we said before, they have to act on it, or they have to honor that options contract if the holder actually goes through with the option. So just good to know. So because the counterparties do not have equal opportunity for both upside and downside changes in value, options are said to have an asymmetric or one-sided return profile. So the difference between the strike and the spot price at any point in time measures the intrinsic value of the option. So remember, the difference between the strike price and the spot price at any point in time measures the intrinsic value of the option. So changes in the spot prices will change the intrinsic value of the option. Changes in the length of the remaining forward period will affect the time value of the option. So if the option is in the money, the option has intrinsic value. An option that is out of the money or at the money has no intrinsic value. The difference between the current value of an option and its intrinsic value represents time value. The time value of an option represents a discounting factor and a volatility factor. Now, the discounting factor relates to the fact that the strike price does not have to be paid currently, but rather at the time of exercise. Therefore, the holder of an option to buy stock could benefit from an appreciation in stock value without actually having to currently pay out the cash to purchase the stock. Thus, the ability to have the alternative use of the cash equal to the strike price until the exercise date of the option has value, because you don't have that foregone cost of giving up that cash. You can use that cash for other purposes, and we all know that free cash flow is king, and the strength of companies for being able to invest or buy more inventory or whatever it might be. So the volatility factor relates to the volatility of the underlying relative to the fixed strike price and reflects the potential for gain on the option. So obviously, underlyings with more price volatility presents greater opportunities for gains if the option is in the money. Therefore, higher volatility increases the value of an option. And what do we mean by volatility of these options? That means these stocks that have great changes and that are very volatile. They change a lot. They're more valuable on those options because obviously that the volatility is what increases the likelihood of being able to make those options in the money. So the value of an option can be realized either through the exercise of the option or through cash settlement. If the option can be exercised at any time during the specified period, it is referred to as an American option. If it is exercisable only at the maturity date or expiration date of the contract, it is referred to as a European option. So, once again, European option is only exercisable at maturity date or expiration date, whereas if an option can be exercised at any time during the specified period, it's referred to as an American option. So let's look at an example of an option. Assume that a call option on 10,000 bushels of corn with delivery in April is purchased in February for a premium of $1,000 and has a strike price of $2.20 per bushel. Now the values of the option at the end of February and March are $1,050 and $700 respectively. It is sold in early April prior to the expiration for $750. So let's look at the relationship between the parties. So here's the option writer and here's the option holder. So the option writer is going to convey the right to buy corn at $2.20 a bushel. And this option holder is going to pay a $1,000 premium for that right to buy that corn at $2.20 a bushel. So let's look here. So once again, we know on 2-1, we paid the premium of $1,000. Okay, so 2-1, we paid the premium of $1,000 right here for the right of that option. On option value at the end of February, as it said, was $1,050. So obviously we bought in at $1,000, so the gain on the option is going to be $50 here, the difference between $1,050 and $1,000. What about the end of March? It says at the end of March, it was worth $700. So in this case, we had a loss on the option of $350. Obviously, the difference between $1,050 and $700 is $350. And we were told that on April 2nd, we sold the option for $750, which gives us a gain on the option of $50. Because if you remember, we had recorded the gain here of 50, the loss of $350. So let us down to $700. So if we sold it for $750, it was already the book value of $700. So we had the gain on the option of $50. So one thing it's good to know that the basic concepts related to the basic concepts related to the call options or the put options are shown in Exhibit M1. So once again, Exhibit M1 on page 517 of the text is a great chart to study for the exam, as this would be a great chart where I could pull questions from regarding the characteristics or basic concepts related to options. Swaps. So a swap is a type of a forward contract represented by a contractual obligation arranged by intermediary that requires the exchange of cash flows between two parties. Now, swaps are customized to meet the needs of the specific parties and are not traded on regulated exchanges. Most often, swaps are used to hedge against unfavorable outcomes and are explained more fully in a later discussion of hedging. So common examples include foreign currency swaps and interest rate swaps. So a good example is a company with a loan payable with a fixed or variable interest rate exchanges the fixed rate of interest expense for a variable or fixed rate of interest. So let's look at an example of an interest rate swap. So rather than involving the swap of different currencies, an interest rate swap involves exchanging variable or floating fixed interest rates or fixed variable floating rates, as we just said from the slide before. So in this example, Let's assume let's assume a company issues 10 million of variable interest debt when rates were 6% and is now concerned that interest rates will increase. In order to protect against rising rates, the company contracts with a bank and agrees to pay a fixed rate of interest of 6.5% to the bank in exchange for receiving variable rates. So in essence, the company has converted its floating or variable rate debt into fixed rate debt. So let's look at the relationship between the two parties here. So as we can see here, here's the company, the issuer of the $10 million debt, and it's paying a variable rate to its creditors, right? So we also know that the company contracted with a bank and agreed to pay a fixed rate of interest of 6.5% rate to the bank. So here's the 6.5% rate to the bank, which is the counterparty. And in return, we're receiving a variable rate, or we're receiving the variable rate right here from the bank. So let's assume that the variable rate increased to 6.7% on the 10 million of variable interest debt. The company's semi-annual net interest expense would be determined as follows. So let's look here. So if the variable rate increased to 6.7%, the company's semi-annual interest expense is going to be $325,000. So how do we get that? The variable interest paid to creditors is going to be the 6.7% times the $10 million times half a year, which is going to give us $335,000. So that's how we get to $335,000. Once again, that's the 6.7% times the $10 million times half a year. So now the fixed interest paid to the bank is going to be the 6.5% rate times the $10 million times half a year, which is going to be $325,000. Now the variable interest received from the bank is going to be the 6.7% times the $10 million times half a year, which once again gives us $335,000. So it leaves us the net interest expense of $325,000. Because right here, the $10,000 is the difference right here between the $325,000 and the $335,000. So that reduces the $335,000 down to $325,000. So rather than actually paying and receiving, the entities exchange the net difference between the rates, which is going to be this $10,000. This results in a net interest expense of $325,000. So the interest swap was entered into because the company feared that the variable rates would increase. So in essence, the swap allowed the company to exchange a variable interest rate for a fixed interest rate as though it had actually issued fixed debt. Changes in the variable interest rates expose one party to potential loss and the other party to potential gain. Therefore, swaps, like other forward contracts, are characterized by symmetric risk. So let's look at some derivatives designated as a hedge. Changes in the value of a derivative held as an investment are recognized currently in earnings, and the derivative is carried on the balance sheet at its current value. Aside from holding derivatives as an investment, derivatives may be used to hedge against changes in the value of existing assets or liabilities, as well as changes in the value of commitments or forecasted transactions. If the hedged item experiences an unfavorable change in value, a properly structured hedge could be effective in providing a change in value in the opposite direction, such that there is no adverse effect. So hedges are generally designated as either a fair value or cash flow. So we have fair value hedges or cash flow hedges. So fair value hedges is used to offset changes in the fair value of items with fixed prices or rates. Fair value hedges include hedges against the change in a fair value of a recognized asset or liability or an unrecognized firm commitment. So, fair value hedges receive special accounting treatment if certain criteria are satisfied. So in order to qualify for special fair value hedge accounting, the derivative hedging instrument and the hedged item must satisfy a number of criteria. So a critical criteria is that an entity must have formal documentation of the hedging relationship and the entity's risk management objective and strategy. The entity must indicate the reason for undertaking the designated hedge, identifying the hedged item and the derivative hedging instrument, and explain the nature of the risk being hedged. Now, this criteria must be satisfied at inception and cannot be retroactively applied. So, special accounting treatment for fair value hedges. So the special accounting treatment results in the gain or loss on the derivative instrument being recognized currently in earnings, and also the gain or loss on the hedged item is also recognized currently in earnings. So for example, the gain in the value of a futures contract to sell inventory can be used to offset the decrease in the value of a firm commitment to buy inventory. So recognizing both changes in value and current earnings gives recognition to the offsetting nature of the hedge. So obviously, if we're offsetting the gain or offsetting the loss, then current income, so that it has to be recognized in current income, the gain on the hedge, in order for it to be fully realized or recognized. Some more special accounting treatment for fair value hedges. Changes in the time value of a derivative is generally excluded from the assessment of hedge effectiveness and recognizing current earnings. So once again, the changes in the time value of a derivative is excluded from the assessment of the hedge effectiveness and recognized in current earnings. What about cash flow hedges? The hedged item is an existing asset or liability with variable future cash flows or a forecasted transaction. So a cash flow hedge is used to establish fixed prices or rates when future cash flows could vary due to changes in prices or rates. So once again, the prices or rates are not fixed. The entity is exposed to the risk that future cash flows may vary due to changes in prices and rates. The derivative instrument can be designated as a hedge and allow the entity to fix the price or rate and reduce the variability of cash flows. Cash flow hedges receive special accounting treatment if certain criteria are satisfied. So the qualifying criteria is formal documentation of the hedging relationship and an ongoing assessment of hedge effectiveness. And other criteria must also be satisfied. So special accounting treatment for cash flow hedges, the gain or loss on the derivative instrument initially being reported in other comprehensive income. So once again, the gain or loss is initially reported in OCI rather than in current earnings because the hedged forecast cash flows have not yet occurred. Now, once the forecasted cash flows have occurred, the OCI gain or loss will be reclassified into earnings in the same period or periods in which the forecasted transaction affects the earnings. So very important there. So the special accounting treatment for cash flow hedges is originally recognized in OCI until the actual forecasted cash flows actually occur. And once these forecasted cash flows occur, they're reclassified from OCI into current earnings. As with fair value hedges, the change in the time value of a derivative may be excluded from the assessment of the hedge effectiveness. So once again, just as with fair value hedges, the change in the time value of a derivative may be excluded from the assessment of the hedge effectiveness. So what are some disclosures regarding derivative instruments and hedging activities? We have to disclose how and why the reporting entity uses derivative instruments. In the case of both fair value and cash flow hedges, how the derivative instruments and the related hedged items are accounted for. And in the case of both fair value and cash flow hedges, how the derivative instruments and related hedged items affect the reporting entity's financial position, financial performance, and cash flows. Okay, and that is all for this chapter here, or on the derivatives module. Please read this derivatives module and review these slides, and give the homework a shot before next class. In regards to questions that what you would see on this on the exam for this is not going to be anything crazy too difficult. I'm more concerned that you actually get the theory and the philosophy behind these derivatives, because ultimately if you have the foundation and the theory down, I feel that you can apply it to any situation if you just apply some critical thinking to it. So once again, that is it for Chapter 9, the International Accounting Environment, and also the module on derivatives and related accounting issues. And it's very important that in this Chapter 9 and this derivatives module that we understand these basic concepts here, because this is going to be the foundation moving on to Chapters 10 and 11. And ultimately, Chapters 9, I believe Chapters 9, the module on derivatives, Chapter 10 and 11 is what's going to cover our next exam, if I'm not mistaken. So once again, it's very important. Please get a good grasp on these concepts that we've covered in Chapter 9 and in the derivatives module here. So with that being said, I will see everyone next class, and we will go over the homework for Chapter 9 and the module on derivatives next class, as well as cover Chapter 10. So with that being said, good luck to everybody, and I will see everyone next week.